We'll run it.
Yeah.
So you
Next
just look
slide.
over me.
So you guys, this presentation was oriented toward real estate sales and mortgage, because they tie in, and yet it certainly affects rental markets one way or the other. Because what's happening with first-time home buyers and existing landlords definitely affects whether or not the rental market is expanded or not. It all ties in. So I didn't change it. I'm just using this one, and we'll just talk a little bit about the support for the rental market. So the big one is the rates and the MBS, mortgage-backed securities. I'll explain what it is and so on, but behind the scenes, most of us have no idea how it's affected our life, but for the last 15 years, the Fed has been doing something that most of us are unaware of, and I'll explain how that works and what it is. The next thing is bank failures. Everybody's all nervous about bank failures. Chill out, the Fed knew what they were doing. I'll explain that piece too. And the next thing is inventory. I love this one here. I highlighted it. Accidental landlords. It's a category, folks, and there's a reason for it. All right, and then we'll go on to who's buying. This was oriented toward what's the profile of a buyer, but it also affects the rental market as well. So this, I love this. I pulled this out because it's like if you listen to the news, you're going in a direction that is different. Let's put it that way.
Right.
The housing market is strong. It absolutely is, and it's going to stay that way. And I'll give you the reasons why. Let's go to the next one. So let's get to MBSs. Most of us might have heard it in the background. What's a mortgage-backed security? All right. We need to understand what it is. The mortgage-backed securities are sold in the market to investors like retirement funds and so on. And they're the ones that replenish the funds to banks and mortgage companies to make new loans. I mean, it's a circle, which I'll show. Next slide. Okay, so what's the interest rate today? It's like, hey, wait a minute. It's up, it's down, it's sideways. I thought rates were going up. No, they're going down. Hey, listen to the news. They're going, it's like, which way is it going? And here's what happens. Now you get buyers and renters that are confused, and therefore they get paralyzed. They don't know should I rent for another year or should I buy? Can I buy? What's the market? What if I buy? Am I buying at the top of the market and it's going to go down? Well, let me answer that for you. Okay, this market is not going down. All right. So as far as the rates go, yeah, they've been bouncing around, and I'll explain to you why and what's going to happen next. Let's go to the next slide. So I put this one on there. You know how we were in our interest rate market where a lot of people refinance, like myself, at 2.625 on a 30-year fixed mortgage? Okay? Yeah, well, that ain't happening again. Okay, and I'll explain to you why. Let's go to the next slide. Mortgage-backed securities. What the mortgage-backed security is, it's a bond secured by a bunch of loans. Put it in simple terms. So let's go to the next slide. Mortgage-backed securities are securitized by certain agencies. Fannie Mae is probably the most well-known. FNMA stands for Federal National Mortgage Association. It is the primary issuer of securities, mortgage-backed securities. So let's explain how that works. Here it is. When you've got a mortgage loan application that comes in, most of us have been there, okay? Whether it's a bank, a mortgage company, a credit union, it doesn't matter. Somebody funds that loan. And it doesn't matter who it is, because what they do is they pool those mortgages. They get, hey, we're gonna put a pool together of 10 million, 20 million, 50 million in these mortgages. And then they take those blocks, those pools, and they sell them to a securitizer. Fannie Mae is the best known. So when those get sold to Fannie Mae. Now I sell my $50 million in mortgages to Fannie Mae. All right, what does that do? First off, as a bank or a mortgage company, it gives me my $50 million back, so I can go make some more loans. Okay, and obviously there's a profit margin, otherwise banks and mortgage companies wouldn't exist. So there's a spread. The next thing is, so who buys this stuff, right? If you've got Fannie Mae issuing a security, who buys it? Well, pension funds, people representing retirement funds, and mom and pop that want a yield on their money with a secure instrument. That's a mortgage-backed security. Okay, so this circle. So here's what you need to know about this. That's the way the system works. But those mortgage-backed securities, normally an investor who's investing in those mortgage-backed securities, whether it's a mom and pop or a retirement fund or whatever, they care about what the yield is. All right? So, but what's happened is since 2008, if you look around, the last downturn, 2007, sound familiar? So what the Fed did, and this is one person that's in charge of your future, okay? What the Fed did is they started buying these mortgage-backed securities, the Fannie Mae securities and so on. So why is that important? Well, I'm going to show you why it's important, but here's what happens. When the Fed buys those mortgage-backed securities, they don't care what the rate is. The taxpayers are paying it. What happens is it drives the rates down. Why do they do that? To stimulate the economy. So, hey, it's a decent tool, but for 15 years, just saying. So here's what happened. Back in 2008, to help the economy, when the economy went off, the real estate market went off the cliff, they're going, hey, we got to go behind the scenes here, buy these mortgage-backed securities, drive these rates down, the coupon rates down, so that more people can buy, get the market back up. Hey, it works. It's such an exact correlation. It's mind-blowing, and I'm going to show you that here next. But I want go back to that slide there, Blake. But here's what I want.
There's the arrow.
Can you go back? Yeah. So here's what you need to know. Okay. For the last 15 years, the Fed's been buying these mortgage-backed securities, but in September 15th of 2022, they stopped altogether. When did rates start going up?
September 16th, 2022.
Yeah. Okay, look, this is not rocket science, folks. But you don't hear the news talking about it. Nobody talks about it. But here's what's happening. So, as of the September 15, this is a date for history. Yeah, no kidding. Because now, here's what you need to. Let's go to the next one now. So, here's what the Fed's been doing, and nobody talks about it. Nobody even knows about it, pretty much. Okay? If you go back here, way back to 2008, okay, they started buying, you see this high, they bought like crazy, drove the rates down, stimulated the economy, lots of people buying, okay, we had all those foreclosures and all this stuff, we needed volume to pick up. It's a good move, makes sense. So what they did was, up to here, and then over the past 15 years, here's what they've done. They still are buying these securities. Now, they have 2.7 trillion in mortgages. They've taken money and they've put it in and they've bought these securities. And then along comes the pandemic. Okay, guess what? They went, so at this point, when the pandemic came along, they had 1.4 trillion in these mortgage-backed securities that they had accumulated over the past 13 years. And then they went, oh my God, the bottom's fallen out. The pandemic came. You know what they did? You see this see this? They bought in 1 year, they bought another 1.3 trillion in these mortgage-backed securities.
So what they took 15 years to do, they did all in 1 year.
Correct.
Wow.
Correct. And so what did that do? It drove the rates down to sub-threes, okay? And so, look, nobody talks about this. Oh, what's gonna make the rates go up and down? What do you think, Bill? Well, I think it depends whether the Fed puts their mitts in there or not, okay? So let's go to the next slide. I couldn't help myself, but I had to find a way to present this where people could see exactly what I'm talking about, because the correlation between the Fed buying and the rates dropping or going up is exact. It is so crazy. I went, I have to get this in it. So here's what I did.
Wow.
If you look at this is the Fed buying, right? It tells you when, look at this is as exact as it gets. When they took off here, look what happened to rates. You guys, this is what's happening. So now that the Fed stopped buying mortgage-backed securities, they're sitting on 2.7 trillion of these assets, if you will, but they're at low coupon rates. So let me give you one more short lesson on that. If you have a Fannie Mae security, and let's say it's $1 million, okay, and the coupon on it is 2.5. You know, back then when mortgages were made at those low rates, and now today the interest rates are 6. What's that $1 million Fannie Mae security worth? A lot less, probably 700,000 instead of $1 million. Well, who's holding all those? The government. 2.7 trillion of these. So just remember that part about the value of the security dropping. That's pretty important, and I'll tell you why. Next slide. Okay. One more little piece in here before we get to the bank failures, okay, is so we have all this buying, right? Driving interest rates down, and then what happens? We get a new administration in, cuts off the oil pipeline, skyrockets the oil prices and the gasoline prices, which affect everything, transportation, food, affects everything. So what happens? Inflation takes off. So here on the one side, the Fed's buying up all these mortgage-backed securities to drive things down to stimulate the economy, and then all of a sudden, bam, they go, oh, we have to go the other way. We have to, because inflation took off, all right, we got to, instead of being down here at 0% or 0.5% the Fed funds rate for banks, they jack it. Look at this. You want to know why rates went up so fast? Because they're trying to now chase inflation. They could care less about the real estate market. Okay, they have another big political problem. They've got all these inflation going on. So it doesn't matter which side of the aisle you're on in terms of politics, but look, folks, facts are facts. If you really know them, then you go, we got people pulling on both sides. Yeah, that's the way it works. Okay, next slide. So let's talk about the bank failure just for a minute, because this subject is always up front. Okay, next slide. Silicon Valley Bank. So let's put a banking hat on. You know how banks work. They take money in, okay, and they pay hopefully low interest on that money, checking accounts, savings accounts, so on, and they lend it out at a higher rate, make a profit. I'm going to say hard, okay, except what Silicon Valley Bank was doing, they had so many large depositors because of all the startups and all this stuff. So what was happening is they had these depositors that had hundreds of millions of dollars in their bank, okay, and the Silicon Valley Bank administration had bought these securities, you know, the ones that the government bought. Silicon Valley Bank was buying them. Well, guess what happened? They had 30 billion or something like that in this mortgage-backed securities. So what happened when the Fed raised the rate? Rather than being worth 30 billion, they're now worth 20 billion. Well, who comes up with the 10 billion? Not this bank. Okay, so what happens is, all of a sudden, the depositors, the large depositors, get wind that this is happening, they'd start taking their money out. In one day, 32 billion is taken out. The bank can't handle that because they've got their money in these securities. They can't sell the securities, get their cash back, they're out of business. Just like that. Bam, bam. Okay, so very interesting. Next slide. So how will that affect us? And the big, now, is it any surprise that the Fed stepped in and goes, we're sorry. Okay, here, we'll make sure that all the deposits are covered and all that. Who pays for it? Go ahead, raise your hand. Us. Okay, mismanagement, bank fit, all this stuff is just the way it is, folks. Yeah, we don't have any say in it, but we pay. It's the way it works. So this part is, will it affect us, here at this level? The answer is not really, because most of the small banks and the other banks that are at exposure, if they're making construction loans or jumbo loans and that, like Safe Credit Union, but look, it might affect the underwriting guidelines a little bit. They have to tighten up only because they have now regulators looking at them like that. But other than that, it's not gonna matter to us because all of our savings are gonna be insured and all that stuff. So let's go to the next slide. Okay, I love this one, accidental landlords. So here's what's happening in the market. Okay, these low mortgages and then housing starts versus household formations. This is the other part that's not published much. It's not talked about much, but absolutely affects the market. So let's go to the next slide. All right, so let's take a person that lives in this area and they refinance sub 3, 2 3/4, 2 5/8, 30-year fixed, and they say, I'm ready to retire or whatever. I think I will move out of the area and buy another house somewhere else. Okay, maybe a different state, maybe. But even if, let's say they're downsizing, okay, but they got a 2.5% mortgage, they don't want to get a 7 or a 6 or a 6. It just doesn't work. Okay, so they say, look, I'll put my house on the market at my price. If I don't get it, what am I gonna do? Pull it off the market and I'm gonna rent it. Yep, that's what's happening. So if you look at the rate block on this, 28% have sub 3 loans. This is the existing ownership. And basically the rest of them are 4%-ish or below, all right? How many people do you know that have a rate of 5% or more? Not many, unless they bought just recently. Next slide. Okay, so what's happening here is, I call it stuck on the sandbar, okay, is the median length of ownership of homes has dramatically increased over the past several years. Now we're sitting on roughly 13 years, okay, stuck. People are stuck, they don't want to sell, okay. I talked to a real estate agent that she was out knocking on doors, they teach you to do this in a lot of real estate offices. She goes, Bill, I keep knocking on these doors. The last one was, the woman looked at me and she says, honey, I'm gonna die in this house. I ain't selling. The message was, I ain't going anywhere. I either have no mortgage or I have a 2.5% mortgage and I ain't getting out anywhere, so don't bother, don't ring my bell again. Anyway, next slide. Okay, there's a little bit of interesting good news on the flip side of this from Q1, okay, the affordability index. I like this chart because here was the average price this is California, and the average income was $158. Now, a year at the end of Q4 2022, the income had gone up substantially, but the housing price is about the same. Okay, so what does that do? That brings a lot more buyers into the marketplace because they can. Next slide. All right, so I hear this all the time, okay, but the buyers can't afford it. Yeah, you're looking at the wrong data. Let me show you. In California, there's roughly 13 million households, of which 17% are able to buy, which is about 2.2 million. And I pull up the numbers for December, there were 66,000 listings for 2 million buyers, okay? Now, obviously, all those buyers aren't moving and all that we know, but here's the deal. There's plenty of qualified buyers. The question is, what's their motive and what do we do? So the ratio is 34 to 1 right now. Normally, it is more like 15, between 12 to 15 to 1. I'm talking about to 1 is the available properties for sale. So let's get to that subject. Next slide. Okay, so if you listen to CNBC, hey, 14.5% February, it went up. Let's take a look at the chart. Okay, go to the next slide.
Sorry, Bill, I gotta,
Someone mute.
You gotta,
It's
somebody's
Deb.
gotta mute, yeah.
okay, let's mute. Okay, here.
There we
Okay.
go. Next slide, that's it. So if you look at this little uptick here, technically what the media said was right, but what they didn't say was, compared to last year, okay, it went from 25,000 sales to 15,000, a decline of 32%. Hey, how about that number? Let's talk about what's really happening. So, next slide. This one, housing starts versus household formations. Oh, what's a household formation? I get asked all the time, because nobody tracks this, but it's a huge deal. Next slide. Housing starts, down 19% in 2022. Does that sound like more inventory? Not to me. That is less inventory coming, okay? The builders are not applying for new permits. It's off by 19%. So don't expect a big flood. Oh, the housing market is wrong. This is going the wrong way. Next slide. Here's one that people don't get. Household formations. What's a household formation? Well, let me put it this way. A millennial, we'll pick on them, okay, decides, because their parents gave them the boot, that they're going to form a new house. They're going to rent a property or buy a property, right? It's a new household formation. That's what it is. People coming of age, forming new households. This is a big deal because do those people need to rent or buy? Yes, it's gonna happen. 26% up last year, 1 year. So we had household formations went up 26% and new inventory went down 19%. What do you think is gonna happen in the supply and demand bucket? Guys, tight.
Mm-hmm.
This market is staying this way because this is what we've got. Okay, next slide. So here's a little graph that shows it. Look at what happened during the pandemic. That top slide, that is new household formations, and you see the downward trend of the new. Hey, there's not enough inventory, folks. There's not enough new houses coming on. You can't get something built here in California. It's a pain. Okay, it takes years. Okay, to get a permit through and all this stuff. I mean, let's face it, it ain't changing anytime soon. So this is what we got. Next one. So I was talking to the real estate community, and I put this up here. Who's buying? All right, who's our market? And also who's renting? I mean, look, they're in a similar bucket. So let's go to the next slide. Next slide. Okay, here it is. I summarized this, and I don't do all this. This is NAR, National Association of Realtors. You guys can pull this if you want to read all the data. But let me tell you, I summarized it because I only have a short time to talk on this stuff. Your repeat buyer is now 59 years old, is back to the baby boomers. The baby boomers took back over because I being one of them, okay, understand the value of real estate. We're going, hey, it's time to buy some, all right? And if you look at, here's another, look, these are the numbers that are posted, okay? 88% are white, Caucasian, and 8% Hispanic, blah, blah, blah. Okay, but here's what it told me. 61% are married, single females, single males, and unmarried couples are the ones, if you look at where the major buying is. So let's go to the next slide. So that's who's buying. 59-year-old married couple has a just saying.
Those people are older than 59 now.
Whoa.
You go, Joe, I'm with you. Just a little bit older, yeah.
Sorry.
They're maybe 69, but yeah.
So as a number, 79.5% of people 65 years old and older own their own home. Okay, so there's a push, there's the people that are not there yet to buy. Okay, but there's also people moving up, moving down, and so on. So here's what I've had a lot of, is a request to buy first, renovate, get it the way I want it, move into it before I sell my house, because I'm not dumb. I see what's going on in the market, and it ain't easy to get one. So I'm gonna get one first. Okay, so you better show me how we're doing that. And if you look at, this was a deal that I did, so I was presenting to these real estate groups. I said, look, this is $1,274,000 fixer-upper in El Cerrito, okay? We did the standard 80% first mortgage, but then they wanted to make sure they had the money to renovate. So what we did is, we did a 10% home equity line second mortgage on the purchase, but this is something Safe Credit Union does that not too many do. We do an investor, non-owner occupied, $100,000 equity line. So we put all this in place, so they only use a very small portion of their cash. So when we closed escrow, now they went to work immediately on the rehab. Okay, they rehabbed it all, and then guess what they decided to do? They said, Bill, you know what, I think we want to rent our existing home because we got this low mortgage on it. Sound familiar? You guys, it's a huge market right now.
It makes me happy you guys all, you get it. That's great. That's good to know.
So this was an example of what's happening with these. The low interest mortgages are actually an asset. You know, if you read Robert Kiyosaki's stuff, you know, you have assets and liabilities. Well, a mortgage is a liability. Well, that's true, you owe it. However, when you have a sub-market mortgage, it's the same as having rent control and a sub-market rent. It's an asset, because it's money you don't have to put out, you put that money in other things. So, just saying, this, next slide. Okay, see this question? So here's what I got, this is for realtors, but this is gonna be a similar thing. Those of you who have clients that they're currently renting and they're going, you know, if I could buy my next one before I sell, then I'm listening, okay? So this is the question, well, I can show you a way to do that, all right? Can we talk? It opens up the door. So this is a summary, all right? Remember this. This is for sure the big one. 2.7 trillion that feds have accumulated over the last 15 years to stimulate. We have lived, folks, in an artificial interest rate economy. If you look at this 5% rate mark, we've never been below 5, ever in history. And the likelihood is you're not going to be below 5 going forward. That's just the probability of it. Because this 15 years was artificially stimulated by the Fed. So just get that out. You want one more piece on this?
Yeah.
Okay, here's the rest, I didn't have time for this one, Joe. These Fed have 2.7 trillion. What do you think they're gonna do with that? Well, let me help you out. Okay, they're gonna start selling that back into the market. And all those mortgage-backed securities what's that gonna do to rates? And they already stated, if you look it up, okay, they already said we're gonna start selling $35 billion a month back into the market. So do you think interest rates are going down? Hell no. Okay, unless there's a war or something, you know, something like that, which hopefully there
Don't
won't be.
say that.
Yeah, well, I'm just saying that, other than a catastrophic event, okay, this pattern is where we're at. You're gonna be above 5 on your.
What's really cool about this is like, I went to see this economist, his name's, doesn't matter what his name is right now, but he can predict everything because you can, if you know the numbers, if you do what Bill's doing, it's talking to you. There's no secret about it, there's no mystery. You just watch like building starts and prices of gas and the government buying this and stuff, and you can see where it's going. And pretty much you look like, okay, well, it's gonna be kind of cruddy for the next 10 years, but 10 years from now, there's gonna be another big opportunity. That's just kind of like the flow, just the kind of the turn of events.
Yes, there's always opportunity. We just need to understand where it is and how we each fit into that with our own personal goals, you know. We just, as Jennifer knows and most people in here, you know, I built another 2-bedroom, 1-bath unit because I'm going, hey, look, for the future, cash flow is king. And if you can get yourself on top of this cash flow game, then life is good. And so you look at what, do I wanna try to buy an investment property and get it to cash flow? Hey, it costs less and produces a better result to put one on my own property. So those of you who have the opportunity, I highly encourage it. Keep your low interest rate, 30-year fixed mortgage. You know, do what you have to do to add. I mean, I'm a big proponent of the ADU and junior ADU discussion because I think it is the highest benefit to the average homeowner. And I probably, you know, talking about that at a real estate meeting when they're trying to get listings, I'm going, hey, don't list, put an ADU on your property, keep it. I mean, look, everybody's got their story. There will always be listings, but it's gonna be at a lower volume level. You can rest assured of that.
And there's gonna be less realtors in the market to make a living. There's just gonna be less for them to do.
So it's already happening. The contraction in terms of volume, you know, people are jumping back, they're going back to previous jobs and so on because they have to eat. And so, you guys, there's always a shift. I've been through this more than once in my history. I got my real estate license in February of 1970.
But Bill, you were 12 back then.
Yeah. So, look, I watch these markets, I see this, and to me, it's like, oh, okay, here's what's going on, folks. So those of you who want to hear it or can get benefit from understanding it, feel confident in your move forward. So for first-time home buyers, I say, buy and hold. That's the game here in California. Just buy, get in. Okay, quit trying to steal a property from a seller who ain't gonna let you do it. Okay? Stop it, pay the market price, get it, get your name on that deed, and move
Mike,
forward.
I told you the old saying, some fellow